Welcome back to Money Media. I'm James and today we are going to cover the topic of leveraged ETFs, so stick around. So look, I've seen a lot raised recently about leveraged ETFs and it's a lot of positive feedback I'm seeing online and in conversations, and so I wanted to cover it. I think it's a really important topic, and it's an investment that comes with very high risk, which I think the risk element of the investment is hidden right now. And so I'm going to explain that in this video. So I really want you to stick around, but to first highlight, or to be able to highlight the risk inherent in this investment, we first need to go back a few steps and explain a few things. So I want you to stay with me. So to understand what a leveraged ETF is, we first need to break down the term. So we're going to start with an ETF. So an ETF is an exchange traded fund. An exchange traded fund is essentially a fund that purchases an asset or a group of assets to allow investors to purchase into the fund and to not have to purchase those investments directly. And so a great example of this is an ASX 200 ETF. So the ASX is Australian Stock Exchange. It has the top 200 companies listed on that stock exchange. And so there is an ETF that purchases all 200 of those stocks and keeps them in the portfolio at all times. And so if number 200 on that list of 200 happens to fall out of the list of 200 and another company comes in, then that fund or the management that manage that fund will sell off that stock that has left the 200, and then they'll repurchase the company that has been bumped up. And so what that allows investors to do is A, have huge exposure to the most dominant companies within the ASX, and what it also allows investors to do is to save money on transactional costs and management fees. Because if you could imagine in an individual investor's portfolio, if they had to buy, sell and manage 200 companies within their portfolio just to have exposure to the top ASX companies, that would be a job in itself. The transaction costs would be exorbitant, and the time it would take to manage that would be more than a full-time job. And so an ETF allows individual investors and companies to have exposure to those top 200 companies without having to buy those assets directly. So that's an ETF in a nutshell. Leverage. What is leverage? So leverage is essentially, in an investment context, leverage is borrowing money to purchase assets. Now, why is that important? Now, more often than not, astute investors and sometimes uneducated investors will borrow money to increase their return or their potential return on an investment. So there you've got leveraged ETFs. So from there, what we can understand is that a fund is purchasing a group of assets, in this case a group of stocks, and they're doing so with leverage as well. Now that all sounds great, particularly when you look at the ASX 200 for the last 100 years, which we've actually covered as well in prior videos, where the average return, if you take that whole period, is 12% on average per year. So it's an incredible return. And so if you are to consider those returns and then consider adding leverage to those returns, then it sounds like a really good investment on the face of it. And so let's put this into a dollar figure. If you were to put $100 into the ASX 200 50 years ago and added just $100 per year to the portfolio, today it would be worth a little over $250,000, about $270,000. That sounds great. Now, if you added some leverage to that, 50%, let's say, so if you've got your initial $100 and you added $50 on top of that, and you did that every single year, you've gone from $270,000 return to a $403,000 return. So you've juiced your profits. Sounds amazing. But with leveraged ETFs, the devil really is in the detail. And so this is what I really want to break down to you now, because we're up to the point of understanding of the leverage, the ETF, and the returns in that particular investment class. So to understand the risk of the leverage ETF, you need to understand LTV, or loan to value ratio. So when you're borrowing money for an asset, the lender wants to know that you have a certain percentage in that investment of your own money. And so that's an LTV, loan to value. So let's say if you've got an asset that is worth $100 and you've borrowed $80 of that 100, then there's an 80 LTV, or loan to value ratio. Now that's all fine and good. If that asset falls, which would increase the loan to value ratio, and the lender steps in and says, hey, you need to pay us some more money to adjust that LTV to bring it back down to 80, because it would have increased because your asset value has gone down. So to understand the risk of a leveraged ETF, you need to understand the ASX, the stock market, in a little bit more detail. Now, the loan to value ratio is managed by the lender on a frequent basis. So in Australia, it's a little bit different. I know America, it is managed on a daily basis, and in Australia, it's managed sometimes at a weekly or a monthly basis. But assuming it's a daily basis, which is the highest form of risk, you need to understand that the Australian stock market, and in fact all stock markets that are slowly trending up over time, don't actually increase more than they decrease. So let's just say you buy this ETF and it's worth $100 and the market goes down by 10%. Then just for that investment to return back to its original 100 before you've made money, just to break even, that same ETF would actually have to increase by 11% just to break even. Now, what if that ETF was to fall 10% in the first day and then another 5% in day two? Your ETF is now worth 85.5% of what you originally bought it at. So just to get back to your original $100, although you've only lost 14.5%, you actually need the market to go up 17% just to break even. And this is where the risk inherently lies. And if you extrapolate that out and you actually look at the stock market on a short-term basis in these small increments that the leverage LTV is being adjusted by, you quickly learn that because there's more down days than up days, the value of your investment is actually trickling down. And so you might have one good day out of 5 or 10 bad days, but that one good day is not enough to get you back to baseline of having lost all those periods. And so that's the inherent risk. And this is where it moves, this style of investment actually moves into a class of what I would call gambling. Now, and we've covered this in the past, that gambling is essentially where it differs from investment, is that the odds of probability of you making money are actually against you, whereas investing, the odds are actually in your favor. And so understanding this, you can critically analyze a leveraged ETF as a high risk investment. Now, for those of you who are saying and watching people online who have made quite a bit of money with these in the recent years, going back about 5 years, which is extraordinary, and I have seen some of the data, it also takes into consideration that we've had markets that have been inflating continually since C19 and everything that went on with that. So we've had obviously the money printing and everything that's come along and how that's fueled some of those asset classes. And so in this last 5 years, a leveraged ETF may have been a good decision in a market that is continually going up, but those markets aren't very common. And if a strategy like a leveraged ETF is used in a flat or trending down market or even a bear market, then the odds of making money swing far against the investor and far in favor of the company lending the money to fund these leveraged ETFs. And so that rounds out my opinion of leveraged ETFs. I've had a few people reach out to me and ask me about them. I think they're a terrible play. I think they're a highly risky play. My hat goes off to people who have made money on them in the last 5 years, but my word of caution is to probably move away from them as the market starts to slow down and even potentially cool off into 2026. Thanks for sticking by, and I look forward to seeing you on the next video.